Hello, this is Jeff Bish, president of MarketGauge.com, and I am filling in for Keith this week as he takes a much needed hiatus. I'm going to take a look at the market outlook from a long-term perspective, as Keith usually does, but I'm going to take the opportunity, since it's a different person doing the market outlook, to give you a slightly different perspective and some slightly different chart formats that I think that every trader should have in their arsenal. Now, I do look at the same indicators that Keith does every week, and you may recognize my chart and my RSI settings as being the same. So this is not to say that I look at the market differently than Keith, other than I'm just taking the opportunity, which I think is rather timely given the situation in the overall market, to show you some perspective and some charts that could perhaps lend a little bit different perspective to your trading in the coming weeks ahead. But let's start with what happened with the SPYs this week, because the SPYs were in the news. We're going to look at gold because that was really in the news. And my objective for this session is really to take a look at the daily situation of the major equity indexes, SPYs, Qs, diamonds, and IWMs, and then expand and look at the bigger picture, show you one way to look at the bigger picture in a really quick way to give you some perspective on which way this market might go from here. Because the news this week, the hype this week, the attention this week, and really leading up to this week was given to the S&Ps trying to take out their 2012 high. So they did manage to do that both on a closing basis and on an intraday basis, but the day that they really took it out with some conviction, we got this big engulfing pattern. Now, on our short-term view, in our daily perspective that we give to traders in our services, I'll share with you that what we're looking for in this pullback and against this level is how the market reacts to primarily the 10, 20 or 30, 50 and 200 day moving averages. All right, so from a short-term perspective, the question for this market is, does it pull back significantly against these major benchmarks? I've got a couple of lines on this chart, and I want to draw them to your attention because we will see them later, but because I also think that they're a critical component to what the overall market might do right now. You can see I've got this channel, and this is I think one of the more compelling points about the SPYs right now. We're at the upper end of this channel. We exceeded the upper end of this channel, and we did it at a point where we're running into some major resistance. Now, I'm going to show you a chart later that has a lot to do with channels, and that just because you're at the top end of a channel doesn't mean that you're going to retreat. But one of the things that you should watch with channels is what happens if you exceed the channel and then come back into it. You don't want the market to come back into it for any substantial amount of time, as that could indicate that an excess occurred. You went outside the channel, there's your excess, and then you came back in. And generally, when excesses occur, this is similar to this concept of a bubble, they don't correct nicely. So in the case of a significant channel coming back into the channel, the correction would typically be, if it's a real correction, going to be typically more than just a little blip back inside the channel. You'll either have an extended sideways move or you'll come back down to the bottom end of the channel. So I want you to keep close eyes on the channels that I draw, and also just a quick lesson on how I'm drawing the channels. I'm taking a trend line low. Okay, I'm taking a trend line low. So if this is our trend lines, and then I'm drawing a parallel line to a point on the other side of the channel, so to speak. So I can form a triangle. That's going to give me my channel lines. So that's what the S&Ps look like, and keep in mind we took out the highs. The question is, do they come back? Traders are looking to sell against that. So on a daily basis, let's just take a look at the other markets and see how they're faring. Now the Qs also took out their 2012 high. I want you to take note that the Qs, however, have not come back and taken out their 10-day moving average. On all these charts that I'm showing you, you're going to see that the 10-day, the 20-day, and the 50-day are all sloped up and stacked on top of one another in a way that's very bullish. And the 200, the black line, the same. I'm not going to spend a lot of time on the RSI, but I will point out that the Qs of all the four have pulled back the least, have really rallied the strongest, and on an RSI basis maintained a level of 99 for several days, and just that is not very normal. And it's done it not only on the daily but on the weekly. So the Qs on an RSI basis are extremely overbought. Does that mean it's going to come back in? It means at some point it probably will. The timing, as I said, we're going to base on the daily charts. Friday's action bounced right off that 10-day moving average. So we're really waiting to see if the Qs are going to give up some of their momentum. They haven't, in the same way that the Dow has, again, looking at its 2012 highs, I think it took it out on a closing basis, but never took it out on an intraday basis, and has been the weakest index in last week. The weakest on the reversal day, and then the weakest on the days subsequent. You can see it got back down to the 20-day moving average. So the Dow we're looking at as the weaker one, trying to struggle against this high, but came back on Friday, and again it at support. So the real question on a daily basis is whether or not this bounce that we saw on Friday can continue to new highs or roll over. Short term, that's really the question that we'll be focused on. And finally, the IWMs are a completely different picture relative to the 2012 highs, not even close, right? So IWMs much different, but also have a much different consolidation pattern in here, and might argue that from a moving average point of view, they're just getting going off of a much deeper correction back to the 200. So the question, if I were to summarize our daily charts here from a trading perspective, is do the Qs, the strongest of the indexes right now, break out and continue to demonstrate that this market wants to go higher? Or are the IWMs, the Russell 2000, telling you from this divergence that the market really isn't ready to go higher, it doesn't have the broad support, and it's time for the market for a significant rest? The Dow is the weakest, coming off of the major highs. The IWM is a laggard but has good consolidation. With that in mind, let's go to a much bigger picture of what's going on. Now the charts I'm going to show you here, probably almost from here on out, are just line charts. There's no volume, there are no moving averages, and I want you to look at the market from the perspective of simply which way is the price going on a daily, weekly basis, and is there a significant price swing that we should be focused on, and is there a significant trend line and channel that we should be focused on? Now you saw on my daily charts some of the same lines that you'll see here. I have them all here so you can see the perspective that I just showed you much more clearly. And let's start with this picture, a big picture. The SPYs just taking out their 2012 high. The Qs just taking out their 2012 high. The Dow struggling but taking out the 2012 high. So all looking at potential major breakouts on a swing basis. And the IWMs in this wedge pattern. The wedge pattern, you'll see as I blow it out, is one that really, if it were to break either way, would project quite a significant move in either direction. So this is why I said moments ago that if the Qs pull the rest of these markets higher, being the strongest. And why am I saying the Qs are strongest? Well, if you look at the more recent low from a couple months ago, that recent low is sitting right on top of the trading action from 2011. And if you look at the recent low in the SPYs, it's way below the trading consolidation of 2011, and the same could be said of the Dow and certainly of the IWM. So the Qs on a big picture have just corrected back down to 2011 highs and are accelerating to new highs. So if that's an indication that the IWMs are going to break out on this weekly basis, there's probably a lot of upside here. I'm not saying next week, I'm saying big picture. I don't think most people in the markets are expecting that. Now, let's take a look at each one on a slightly more detailed view. If we look going back much further, the SPYs are bumping up against some significant resistance levels over here. I've also drawn in a much bigger channel that we see in the SPYs here, the dotted lines. A little bit higher, and we're going to start to bump up against that level. Really what I should do, because the way I've drawn this channel is one that describes the price action instead of being pure. So what I mean by that is that a pure channel would really be the top line. Excuse me. Real channel will be the top line, but the lower line really describes three significant hits. So if we get back up to this top line, probably another couple of percent from where we are now, the lower line is going to describe good resistance. The upper line is going to describe the more true channel. Either way, this whole zone, we could call it, as we're looking forward, probably up to the 150 level, is going to be the top end of the channel. That is also going to line up with this more accelerated channel we have here. So if the SPYs start taking off in a more parabolic way, keep your eye on 150, which is going to line up again with this high in here. Another significant level that we'll want to watch on the upside will be the lower end of this consolidation in here, which lines right up with the what I would call the market action top channel. Right, so that level is about 144. That's probably on a closing basis a level you should be focused on over the next couple weeks. So SPYs still in that up channel, key level 144, and a key trend line. Now in each market I want to point out a key trend line. If the SPYs, the bigger picture here is that if the SPYs roll over at this level, traders sell against the highs, we pull it back. We don't want to break the trend line, and Keith highlighted this last week, I believe. We don't want to break the trend line coming from the lows of September, October 2011. Right, so that the big picture is, do the markets hold and move higher, or do they break and then come back, and the next big level is going to be this trend line. Let's take a look at the diamonds. Let me go grab the diamonds. Okay, so same essential analysis. Where is the high? We're just kind of taking it out. If we fail from that high, where's the trend line? Interestingly, the trend line is going to come in right around the highs that we see from early 2011. That's about the 128 level. So 128 to where we are right now is the key level. After that, we're looking at the 2007 highs. Let's take a look at the IWMs. Okay, now you can see the significance of this wedge right up against the 2007 highs. So in a big picture, we've got a market that topped out in 2007, has come back to that level, and has formed a huge wedge. A wedge that, as I said, if it were to break higher or lower, could indicate substantially higher or lower prices. There's two areas I want you to focus on the wedge, though. I've got two significant lines. One is if we break the wedge to the upside, where's the next significant swing? And it's right here around the 83 level. So really measuring the break of this wedge, if we break the wedge, watch out for the 83 level on the upside, and then naturally we'll be looking to see if it can break the highs from 2007 and 2011. On the downside, if we break the wedge, we've got a very interesting confluence of this swing high here around 74, just under 74, lines up with this significant high here and this significant high here. So 74 on the downside is a very important number. And so when I say very important number, these are important numbers if they break. They're important numbers to look for support. Keep in mind, this has nothing to do with moving averages. This is pure price action. Now let's take a look at the Qs. Okay. Significant channel in the Qs. And I say significant because essentially Qs rallied strongly off their bottom and then consolidated. And from that consolidation low, I draw this trend line. And from that trend line, I draw a channel. A channel which did a very good job at identifying the extent to which the market would move coming out of its breakout from 2011-2012 consolidation. So it's extremely reasonable to think that if we get back up into that trend line or over that trend line area, we will see some resistance. The trend line that we are worried about is coming in around 65. Okay, so let me blow this out a little. So just like the SPYs, just like the diamonds, if we roll over at this level, where's the critical trend line that we want to pay attention to? It's this one coming off the 2011 lows. I've cheated it a little here because if I do that, I get these 3 points. So I think it's an area around 65, and then the natural next level is going to be this low here, which lines up very nicely with these highs here. So between 60 and the 59 level, it's going to be your major areas of support in the Qs. So the summary here is that you can see all four markets have channels that they are running up against but have room to reach to get up there, and they all have a very significant trend line that you should be focused on a weekly basis. If the Qs break, we're going to look for the IWMs to get into gear and demonstrate that the broader market is with it. Because without the broader market, we know that we're going to be in a really late stage of the move. So if the broader market doesn't get going, it's going to be a huge warning sign. I want to go back just quickly to the SPYs to give you the example of the channel I spoke about. You may have seen it, and I didn't talk about it. The channel in the 2004 in the SPYs, 2004 you can see goes to 2007. all the way up to really the highs is a really good example of an extended channel and the power of looking at the markets this way. The channel from 2004, the middle of 2004, all the way to, let's say, the end of 2006, did a very good job at describing the general support and resistance levels in a trending way. This channel is similar to the channel that I've drawn here. It's similar to the bigger channel that I've drawn in the Qs. We'll look at it the same way. What I want to illustrate here is that channels are perfectly capable of being broken, and when they're broken, you just have to recognize that the market is in a rather accelerated phase, and you want to wait, as I said, for it to come back into that channel and continue lower. So in this case, you can see it came back but held the upper side of the channel, went on for another move, came back, held the upper side of the channel, went on for another move, came back, tried to go on for another move, but then failed. All right, it's this tried to go on for another move and then failed that we're in currently with the daily channels that I described. So it's that price action that we are going to watch out for. So I hope that helps with the perspective of channels and just looking at the weekly price lines. And I'm going to close with another market that's been in the news recently. Gold. I'm going to look at it the same way. This is a weekly chart of gold. The news has been really excited about the fact that it's had this big move in the last week, which, granted, it has been a big move, but really here's the big story in gold to me, which is if you take a trend line from the 2011 highs on a closing basis, we took it out. Now if you take the same trend line on a intraday basis, we haven't taken it out, but we held this level and now we're breaking out above the trend line. This is the significant pattern here for me. So if we pull back, what we're really going to look for, if we're going to find another explosive move in gold, if it doesn't just continue, which gold is perfectly capable of doing, but if it pulls back, the big picture to keep in mind with gold here is that this trend line is being tested after having been broken, and a pullback and then a move higher would really be significant for the bulls. One of the things that makes me think that this could really be real is that I always like to look at silver at the same time and in the same way that we're looking at gold. I like to see it doing the same thing. And in this case, not only is it doing the same thing, but silver took out this prior low and didn't continue. So it really tested the downside. And if you'll notice, we had a swing here that led to a break and a significant move lower from that swing. The new swing low slowed down. The final swing low didn't do much at all. And not only did it recover this level, but broke the trend line from the highs. So the exciting thing for the bulls or the bulls in gold, I think, is really that you've got silver doing the same thing. So keep an eye on silver as well as gold. Now I probably shouldn't talk about all these markets without at least looking at the TLTs with the same perspective. And Keith focused on the TLTs last week with their pullback to the moving averages and looking for support, and he was absolutely right. It bounced today. Let's take a look, as you see it here, at the TLTs with the same perspective that I've been looking at the rest of the markets. TLTs have broken out of a significant high. They just came back and bounced on that high. Keith focused mostly on the moving average, part of the support, but there's also this very significant price action support and very significant closing trend line from these highs. So similar to the channel concept, and I didn't draw the channel in here because it's just so steep. Similar to the channel concept, the trend line concept. We broke this, we touched down on this level. If we come back up and then roll back through, it's going to be a very significant break here in terms of the TLTs. And while it's kind of hard to believe that the interest rates will be able to rise because of a stronger economic implication, it certainly, from a charting perspective, suggests that if we break down through these lows, interest rates have plenty of room to rise from the TLT time frame. So I hope that helps, and I wish you the best in your trading, and I hope that you'll take from this video that just looking at the line charts and seeing the big patterns can give you a very helpful perspective.